For decades, risk modelers evaluated consumer debt through a structural lens, treating a term loan and revolving credit line as isolated financial pillars. But when you actually look at real borrower behavior, those pillars completely crumble to reveal a tightly interconnected web. The standard approach relies on two separate metrics: probability of default on a term loan and exposure at default on a credit line. But empirical reality shows these operate in a continuous feedback loop, where strain on one directly accelerates the other. Despite this mathematical reality, upcoming global banking regulations rely on assumptions that misinterpret this dynamic. Evaluating these financial instruments in isolation creates systemic blind spots. It produces an inaccurate picture of individual risk, threatening the entire consumer credit portfolio's stability. The tension centers on the Basel III Endgame proposal. U.S. banking agencies are pushing to update capital requirements across the financial sector. The mechanism is a 10% credit conversion factor, a mandatory capital charge penalizing banks for the unused portion of consumer credit lines. In the U.S., this untouched portion is massive, 80% of available credit. Regulators assume these open credit lines represent a latent risk. They treat them as ticking time bombs, waiting to be drawn down the moment a macroeconomic crisis hits. By synthesizing empirical bank-level default data with real-world consumer behavior metrics, we can see exactly why the Basel III capital charge miscalculates the mechanics of consumer liquidity and distress. The empirical foundation for this comes from a cross-sectional dataset of nearly 15,000 retail borrowers at a leading Canadian bank. Every individual in this sample holds both a term loan and a revolving line of credit. The methodological challenge here is isolating the exact mathematical relationship between those two instruments without falling victim to endogeneity bias. Endogeneity bias happens when two variables constantly influence each other, making it difficult to figure out which one is the true cause and which is the effect. To solve this, researchers modeled both financial instruments inside a simultaneous equation system. They used a Probit equation, a model designed to predict binary outcomes like default, and a Tobit equation to model credit line utilization percentages. Notice the mathematical cross-pollination. Credit line utilization serves as a driving independent variable in the Probit equation, while the term loan default acts as a driving independent variable in the Tobit equation. When subjected to a walled test of exogeneity, a statistical calculation that checks if variables operate independently, the results strictly reject independence. This econometric proof demonstrates that the isolated risk model is mathematically untenable. A consumer's financial instruments are inextricably linked in times of distress. We can trace the exact severity of this link by examining the marginal effects flowing outward from the credit line to the term loan. The quantitative impact is severe. If a consumer shifts from 0% to 100% credit line utilization, it triggers a 46% increase in their probability of defaulting on their separate term loan. The equations also track the reverse flow, showing exactly how an existing loan default impacts a borrower's behavior on their revolving credit line. The data reveals that a borrower who is already in a state of default uses their revolving credit line 59% more than someone who is not in default. Liquidity distress on one instrument instantly bleeds into the other. High credit utilization serves as a specific mathematical indicator of broader default, distinct from the simple presence of debt. To understand the behavioral mechanics driving this distress, the researchers applied the McDonald and Moffat-Tobit decomposition. This is a mathematical technique that separates a population's behavior into two distinct groups based on their starting state: the intensive margin and the extensive margin. The intensive margin represents borrowers who are already actively using their credit lines. When facing a loan default, this group accelerates their borrowing to meet short-term liquidity needs. Paradoxically, the extensive margin, borrowers sitting at exactly 0% utilization, act entirely differently. When facing default, they actually avoid tapping their open credit lines in an attempt to prevent further financial entanglement. This behavioral divergence highlights a flaw in standard credit scoring. Because traditional scores rely heavily on historical delinquency proxies, they fail to capture these nuanced financial constraints. To fix this, the researchers propose an ability to pay metric. This factors in a borrower's predicted living expenditures and the number of external active credit lines they hold, capturing true, real-time liquidity constraints. true default risk is a real-time measure of a borrower's available liquidity constraints and their behavioral margins, rather than a backwards-looking history of late payments. If high utilization mathematically predicts default, we must look at the economic reality of low utilization accounts targeted by Basel III regulations. A recent dataset provided by TransUnion analyzes 1 million U.S. consumer credit card accounts to map exact usage behaviors across the population. This chart shows the distribution of consumers by pattern type, revealing that fully 50% of the sample are classified as transactors. A transactor is a borrower who pays their balance in full every single month. These transactors hold the vast majority of unused credit lines. They utilize very little of their limits, and statistically, they pose incredibly low risk to the lender. Looking at this chart detailing the distribution of consumers by income group, we can test the regulatory assumption that these low-risk behaviors are strictly limited to the wealthy. The data provides a critical counter-narrative. Nearly 40% of consumers earning under $50,000 a year are also classified as transactors. These massive unused credit lines act as liquidity buffers for moderate-income households, providing the flexibility needed to navigate monthly expenses. We can now revisit the Basel III Endgame proposal's 10% CCF capital charge in light of the TransUnion transactor data. This charge financially penalizes banks for maintaining those low-utilization, low-risk accounts. It forces institutions to hold expensive capital against credit that is rarely actually used by the consumer. Because the proposed CCF overstates historical loss experience by nearly double, banks are heavily incentivized to shed this artificial dead weight from their balance sheets. The immediate and logical banking response is to aggressively slash open credit limits or outright close inactive accounts to save on capital requirements. This automated risk mitigation disproportionately targets the liquidity buffers of moderate-income transactors. By blindly taxing unused credit, macro regulators are actively forcing banks to strip away the exact financial safety nets consumers rely on to absorb macroeconomic shocks. Consider the basic mathematical consequence of a bank slashing a consumer's credit limit while their monthly spending volume remains perfectly constant. This bank action artificially and instantly spikes the consumer's credit utilization ratio, even though the consumer hasn't spent a single extra dollar. The immediate secondary effect is that this mathematical spike automatically damages the consumer's credit score, locking them out of future financing. Connecting back to the micro-endogeneity proof, the consumer is stripped of their buffer, locked out of cheap credit, and operating at maximum line utilization. This connects back to the findings of the Canadian dataset. Reaching maximum credit utilization corresponds with an exact 46% increase in the probability of a separate term loan default. Regulators and banks must adopt an endogenous portfolio view of consumer risk. Penalizing unused liquidity doesn't buffer the financial system against default. It actively accelerates the exact mathematical conditions